Hello, this is Eric Boyce, the CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Charts of the Week for September 28, 2020. Please see our disclaimer for important information. So as we start our chart pack of the week, we revisit our old chart here, the 7-day moving averages for new daily cases for coronavirus, as well as new daily reported deaths. We can see the death line continues to trend down, which is a plus. The new case load is trending up, and as we'll see in the next chart, there's clearly some participation by just about all regions of the country, but obviously corresponding to the reopening of schools and things like that, leading to a lot of this caseload increase. Here's that geographic chart that I mentioned. You can see that really the Northeast has had perhaps the most muted increase, but clearly there's been an increase in the Northeast. But if you look at the other regions, it's been a little bit more pronounced than what we've seen up on the eastern part of the U.S., particularly in really the Midwest has really probably received the most publicity of late. Here's our chart on high frequency data that First Trust puts together, our friends up in Chicago. And as we look at the data week over week, we have had some noticeable increase in TSA checkpoint data. That's up 5.7. Motor gasoline supply up about 0.4%, and restaurants seem to be increasing at a reasonable pace. Now we've had a noticeable downtick in hotel revenue per available room and daily rates, and that probably correlates perhaps a little bit with reopening of schools and things like that, but probably not directly. But steel ton production down slightly, but key data point there is that we've seen an increase over the last month in that, and rail traffic. We've got some charts on other high frequency items coming up in the next few slides, but obviously we're seeing movie theaters begin to reopen to some degree, and that data is really lumpy, and we've seen basically some positive performance out of some of these high frequency indicators over the last month, just reflective of the fact that schools are back in session, people aren't driving, even movie theaters that were up quite a bit when they began to reopen are now down quite a bit over the last week, and that obviously relates to having kids in school and what have you. Here's some other charts on high frequency data, and it just really, not to kind of bore you with the aggregate details, but just kind of focus on the trend lines. You can see on the left hand side, all of those areas that kind of feed into this high frequency stuff. Supermarket volumes are still down below, but you can see kind of a very familiar trend line on all of those other categories there, whether it be airports, hotels, bars. We know a lot of those still remain shut, as well as movie theaters. So it's some very similar trend lines there, and perhaps a little bit better performance out of sit-down restaurants as they've been allowed to open at perhaps 50 to, in some cases, 75% of capacity. Now on the right-hand side, this would be a chart that comes to us by Civic Science, and I thought it was really interesting because it shows the percentage of folks that would be in fact comfortable to go to restaurants, and this is just kind of a sentiment indicator on how people essentially feel about the pandemic right now, and now that number is up to 50% of the population would be comfortable going out in a restaurant, and those in 6 or more months continues to eke down ever so slightly. So interesting data point there. This relates to a couple more items of the high frequency spectrum here. We've got Port of LA container imports and weekly intermodal rail traffic, and intermodal just relates to the transportation of consumer and in some cases durable goods across the country. And you can see both of these indicators are trending much higher after having troughed earlier this year. And in both cases, this is really good news and You can see on the right-hand side for intermodal traffic, I mean, the number is actually higher than the average of the 2 prior years. So strong data points, again, worthy of continuing to monitor as we sit here on the eve of, and actually now officially in fall, but on the eve of what could be an interesting flu season and potential recurrence of COVID-19. And we know definitely globally COVID is picking up. So we just have to monitor these high frequency numbers continuing over the next several months. This is a little chart on vaccine production, and I think what's really poignant in this data here is that the volume production for vaccines is clearly not expected this year, regardless of what might be promised in the election rhetoric. Clearly there's going to be doses that are going to be available to frontline defenders, but I think the availability widespread of vaccines for the general public is just clearly going to take some time. And however much this is going to weigh on consumer sentiment, on consumer activity, consumers represent 70% of the economy almost. It will have to wait to be seen, but clearly the availability of a vaccine is a prime inhibiting factor for people not going out as much and not traveling as much. That number clearly on the restaurants that we saw a couple slides ago would clearly be a lot higher if vaccines were closer to being available. A couple of charts on credit and income, and on the right hand side is the University of Michigan. This is expected household income, and a pretty somber look both at that and credit availability as we see credit's getting tighter, lenders are getting more persnickety. It's tougher to get credit, especially if you don't have it, and a lot of adjustments are being made for PPP income and things like that, taking it out, and people are really being hamstrung over the fact that incomes were down because of forced shutdowns and things like that, but lenders are definitely tightening up the screws, and that's having an impact on credit availability, but also the expectations for income declines is beginning to really take shape for 2021. And here we have a couple of slides related to consumer activity and sentiment. On the left-hand side is a momentum in the recovery of confidence, which we can see here as you track it through 2020 year to date. Continues to be below our levels that we saw before the pandemic hit. They do continue to trend up a little bit. Maybe they slowed a little bit. If you look at that last bar on the right-hand side of that left chart, it just ever so slightly downticked. So obviously that's something that we are acutely concerned about, but I think it's maybe not as significant a change unless it forms a trend over the next month or so. On the right-hand side, we plot retail sales and the University of Michigan confidence number, and you can see confidence just overall remains low. I mean, these two charts really corroborate the same type of trend that confidence is clearly below where it was at the beginning of the year. But I would argue at the beginning of the year it was extremely high, as it has been for much of the last couple of years. But we've got to continue to battle back to win the hearts and minds of the consumer. We know that spending is up. A lot of that actually has to do with the fact that you've got lower incomes that are spending more of the income that they're getting, spending more of that stimulus money that they received earlier this year. And we know that savings rates amongst the higher income cohorts have really increased. But this number on the right-hand side, the blue line, represents retail sales and food services. So obviously food has contributed because restaurants have reopened, but retail sales, this is kind of an interesting chart because sentiment is low, people are spending more, but the spending is not distributed evenly between all of the income levels. Now we'll talk about housing for a couple minutes here, and this represents just a snapshot of how strong the housing market has been this year. It's really been a tremendous market just in terms of activity, and not only in permitting but also sales. This is new single-family home sales, and you look at the trend line relative to the rest of the years dating back to 2013. You can see a clear outperformance this year, especially at a time where we typically see a lot of seasonal weakness in volume as people are struggling to get settled in before the school year and whatnot. So very interesting data point here. This is a chart that reflects home prices, so this dovetails with the activity. So it really is a seller's market right now. We've had a really strong price movement overall, and this is a national number. It's averaging about 8% year over year. It was 7.3% a month ago, and it was even up 5% last year. So we're seeing more acceleration. This data point here is expected to increase. Data that comes to us by way of sober look in the daily shot, expected to accelerate even more through the end of the year. Now, this is an interesting data point, and it's not really well understood unless you parse this data. And so what this is from the Federal Reserve Bank of St. Louis is they parse new home sales by price cohort. And so really the purple line-ish, if you want to call it purple, represents home sales between $200,000 and $300,000, and then the black line represents home sales between $500,000 and $750,000. You can see that the volume of higher end homes has really kind of dropped off, frankly, at the same time where well, what I'll call probably starter homes has really shot through the roof. So the home sale numbers seem to be disproportionately skewed towards lower end and more first-time home buyer type properties. And this chart with some interesting colors on it represents kind of a snapshot into the mortgage market. And I think the key takeaways here, as we've kind of tracked through 2020, as we see in April, we had a rise in the 30-plus day delinquencies that have now really given way to the 90-plus day delinquency. And we saw a huge spike in non-performing assets, and perhaps maybe that number's kind of come down from June a little bit, as maybe there were some forbearances and some workouts and things like that. But I thought it was interesting that the 90-plus day delinquency number now constitutes the majority of this overall delinquency. And you know, when you start getting into longer term credit problems, it has such an impact on mortgage-backed securities. It has an impact potentially on pricing and within the housing market. You know, if there was something that could you know, throw cold water on the home price appreciation that we've seen, it's a rash of new inventory on the market being sold at fire sale prices, or at least discounted prices, to clear real estate owned off of bank inventory for as these 90-plus day delinquencies, you know, potentially transition into outright foreclosures. This is a snapshot of really the state of the corporate market, and kind of a brief indictment of corporate balance sheets, and it looks out over the mainstream. You can see on the left hand it's corporate liabilities as a percent of GDP versus this long-term trend line, which actually goes back to 1970 in this particular chart from credit sites, and it's data from the Federal Reserve. So you can see it's really interesting. It's worth kind of spending some time reading from left to right of all the things that have gone on that you know, in our lifetimes. But you can see as you get towards the right end of that when we had, you know, in 2016 we had a lot of new issuance, and issuance of that marginal credit quality. I mean, those layers that were just above investment grade, and so that's really perked up, and we've seen more corporate issuance, and we've talked about this and not only in our chart pack, but also in our market minutes as well, that corporate debt as a percent of GDP was rising well before the pandemic. And as we can see now, there was a rush on credit as corporations that had reasonable credit worthiness were basically hoarding cash, drawing down their lines, trying to really term out their commercial paper, which means taking the commercial paper that you typically roll on a short term, really inside of 30 to 90 days, and make that more permanent debt, trying to take advantage of the fact that get it while you can, as well as take advantage of low interest rates. But what you can see there is that as of June 30th, we were 158% almost of GDP in corporate liabilities as a percent of our economy, and that's a profound deviation from our long-term trend line. So worth watching. On the right-hand side, we clearly see that defaults are likely going to wind up this year, if the current trend holds, that we're going to exceed the default rate that we saw in the financial crisis of 2008, 2009. And that's pretty interesting and poignant in and of itself. But you just dovetailing those two means that what we're seeing is a real potential pinch on corporate balance sheets and going forward, and a real potential pinch on credit availability going forward if these default numbers really begin to take root, because that's going to have ripple effects throughout the entire secondary trading market. It's going to have ripple effects, obviously on credit assignment, and probably have some ripple effects on banks' willingness to lend, and perhaps seeing more credit tightening as we've already seen on the consumer side. Current account balance, this just relates to trade. We know that that has been really, really challenged lately. We see that that our current account deficit is now almost $175 billion. What does this really mean? It just means that you potentially see continued dollar weakness, which obviously would help exports, but again, in a purchasing power parity sense, it's just your dollar doesn't have as much strength behind it when you're running a much higher current account deficit. And this probably should have been lumped in with the corporate information, but I'll kind of circle back to this. This is just the fact that we've seen a huge rise in junk bond issuance this year. No surprise. We saw that in the other chart. We know that that trend line was moving up over a period of several years, and you can see it here that on just the part of the market that's represented by junk bonds, which are bonds that are well below investment grade, are moving higher and higher and higher. This is a quick summary of gold, and I want to caution that this chart only goes back to the beginning of the month, and there's a reason for that. We did see a tremendous surge in gold and really the precious metal basket, if you will, including silver, but it's really tempered that increase over the last several weeks, and you can see that here, even at a time where we know that real interest rates are decidedly negative and likely to stay there. We've nevertheless seen this peeling off of the kind of the froth in the gold market. And in fact, I would argue strenuously that it was really kind of ahead of itself in terms of its price appreciation relative to the pace of the dollar and the pace of real interest rates. What's interesting here is that gold is off 5% plus from its peak. Now, silver obviously tends to be, perhaps maybe a little bit more volatile than gold, is down much more than that. Crude oil production with $40 a barrel of oil, we seem to be kind of consolidating at a production level that's a little bit lower. Obviously, we had a hurricane disruption, which is evidenced in both of those years, and that's not atypical for a year in which you have an active hurricane season to have those bumps. But clearly from April, when we saw our big drop, we are kind of in a holding pattern, if you will, and not likely to attain higher levels certainly not at $40 a barrel for quite some time, or at least until that number probably ekes up by most yardsticks. It really needs to average about $50 to $55 a barrel before you can really interest a lot of upstream producers to reopen shuttered wells. Just another comment on S&P 500, as we've talked about over probably the last couple of months in earnest, that you can see that where we are in terms of valuation is high. Now this is from Haber Analytics as well as Standard & Poor's, but you can see that if you just run price to operating earnings, and this is more of a non adjusted earnings, if you will. It just relates to operating earnings, almost like a price to EBITDA ratio. You can see here that we have reached rarefied air in terms of our market valuation. Now, these two charts, we get a little bit of perspective on the stock market. I'll actually start with the chart on the right from Yardeni, and this just shows you the average index change on a monthly basis dating all the way back to 1928. I thought it was really interesting for perspective's sake that September, which has not been a very good month this year, is traditionally not a very good month. In fact, it's the weakest month generally on record that we have during the year, and the average loss is about a percentage point in September. So again, not to get too excited about the recent market activity. Obviously, there are time-specific issues that we're facing. Election, we're facing China, we're facing obviously the pandemic and the fallout from that on small business and employment, etc. But September typically is not a good month in the market. So just take that for what it's worth. On the left side, we highlight here this really dramatic change in I won't necessarily call it leadership, because there's still leadership amongst the large technology firms, but they've had a correction. Now, there's some who speculate that there's been a lot of option activity that has influenced this rise, and I won't go into the mathematics of it, but there is a plausible argument that there was some underlying options activity by large institutional traders that were helping to prop up technology stocks, particularly the FANG stocks, which are Facebook, Amazon, Apple, Netflix, and Google. But those stocks have really corrected as a percent lately. You can see that this rise in 2020 year to date, the FANGs relative to the S&P 500 have really taken off. And we've seen a correction, or kind of a retracement, if you will, of about maybe 20% of that gain from its peak a little bit earlier in August. But at the same time, we can see industrials, which is represented in the blue line. Again, FANGs are in the red, industrials are in the blue. The relative performance of industrials to the overall index, which we know is dominated by tech stocks, has been particularly weak this year. But the good news is we're seeing this kind of ever so subtle change in leadership right now, in the sense that industrials are becoming a little bit more relevant, while the technology stocks are becoming perhaps slightly less relevant. And this will be a trend that we want to watch. And I think if you have better and more broadly represented activity within the index, meaning that you tend to see more of the index moving in unison as opposed to the index being driven by just a handful of stocks, that would certainly be helpful for the market. Here we have another perspective, perhaps, on the kind of the advent, and I don't know that you could characterize these as necessarily younger investors, but you do definitely see small options trades. Now, this is just a volume of trades from the Chicago Board of Exchange, and typically what you'd associate this type of chart with is these are not institutional traders. These are small options trades. I mean, maybe 1, 2, 3 contracts, and you can see the dramatic rise. And so what this tells you is that retail investors, the smaller investors are getting involved in the market, and they're becoming more relevant than they have. And this is a trend that's been playing out over a number of years now, and it's really kind of taken root and perhaps accelerated here in 2020. Small caps just continue to struggle, and we can see this cyclical cyclical chart in terms of profitability. That's basically, you see those dips that are tied to overall recessions. And what this shows you is that you just have, we've had a real drop, a noticeable drop in the number of profitable companies in the Russell 2000 index, as well as the S&P 500 index. And if you look at the kind of that gold brownish number, I mean, obviously we had at the end of 2019, most of the S&P 500 companies were profitable, and now that's dropped somewhat. And even in the Russell 2000, I mean, that, which is typically a lot less, you tend to find smaller companies and perhaps earlier stage type companies as opposed to what you'd find in the S&P 500. But that number was lower in terms of the number of constituents, and it continues to go lower. Now you've got essentially 40% of the Russell 2000 index that is not even profitable. And we've highlighted this before, but this is a pretty telling trend right here, and one would hope that it reverses because it would more than likely have adverse impact long term. Global Economic Policy Uncertainty Index. Now this is a good thing because the numbers are going down. The Economic Policy Index on the left-hand side is noted in black, and the trade-weighted dollar is on the right. And you can see that, notwithstanding what we were talking about earlier in its relationship with the dollar, but here, basically economic policy uncertainty, when times are in flux and people are uncertain, they typically flock to the dollar. So you can see a really positive relationship here. And the fact that policy uncertainty, regardless of what you see in the data for coronavirus infections rising across the world, policy uncertainty is going down right now, and it's kind of getting back to perhaps those levels that we saw in 2019, and with it you see the corresponding drop in the dollar. So this is yet another thing aside from interest rates that's kind of weighing on the dollar right now. Inflation expectations. We've got two charts on inflation expectations. Now, we have been, interested in what happens to inflation. We know that it's very low right now. We know that there's a lot of liquidity sloshing in the system, which typically the velocity of that money and that liquidity in the system would typically inspire higher inflation. But as we saw in the QE rounds after the great financial crisis, it didn't manifest into inflation. But here lately, we've seen just an inordinate, historic amount of fiscal stimulus, and this whole notion of modern monetary theory that when interest rates are close to zero, your debt, your national debt doesn't really matter. And so inflation expectations have clearly eked up a bit, but they're off their peaks. And I mention that because very interestingly enough, here on our next slide, we can see that the TIPS volume has gone absolutely through the roof. I mean, this is really unprecedented, and we haven't seen this in quite some time. So these are record inflows into inflation protected ETFs, or Treasury inflation protected securities, or what we call TIPS. So very, very interesting dynamic here. I thought this was particularly interesting just from a historical perspective. I mean, we know that interest rates are at historic lows. This is a chart of the 10-year U.S. government Treasury yield dating all the way back to 1786. I'm amazed and thrilled that we have that data, but you can see that there's been there was a long secular decline for essentially about 150 years, from the birth of the nation through the war, and then those interest rates went up as the Great Society ensued, and obviously inflation. We had OPEC embargo. We had that environment in the 1970s, and then Paul Volcker came into the Federal Reserve as chairman there at the early 80s to combat inflation. That's when we began this massive secular decline in interest rates, which leave us where we are today at these historic lows. And this just provides this long-term perspective, and really just the perspective that, how much lower can interest rates go? And there's no appetite for negative 10-year rates like there has been in other parts of the world. So if you assume that, and you assume the Federal Reserve is committed to keeping rates low, probably at least for the next 2 years, that's going to have broad implications across our economy, a huge impact to savers, obviously borrowers. If you can get credit, it's good for you. But as we've seen in the prior slides, credit has eroded and credit standards have gone up on the part of lenders. So this is, we'll just have to wait and see. So in our final slide this week, I thought I'd find something kind of interesting coming from somebody who was a high school DJ and have always maintained a large LP collection during the time where, we transitioned from, basically 8 tracks to cassette tapes to CDs, and now, most things are digitized and not in physical form. Now that we've had a really massive resurgence in the interest in vinyl LPs. And I thought this was very interesting because I didn't realize the trend had taken on this much weight. But as you can see here clearly, over the last 15 years, there's been quite the reversal in interest in buying LPs. So there you go. Well, that will do it for this week. And hope you've enjoyed this installment of Charts of the Week. Please let us know if you have any questions or comments at the information you see provided. Hope you have a safe week, and we'll talk to you soon.